This is a head at a localized low for a gold chart that has been struggling recently. I'll go out on the bigger time frames just now. And there's your right shoulder for us. We call these armpits the interaction with the neckline. So that would be armpit 1. People can find out about our phraseology and our lexicon of terms. We only have and we only deal in horizontal necklines. It's the price point that matters. 4,360 is the magic number. You could probably argue that's 4,350 and you just run the levels normally. We pushed it a little bit. Why? Because we want the biggest projection, and the biggest projection will give us the target, which will bring you to the foothills of 4,700 if wash comes and does what we think. So that's an inverted head and shoulder. We'll see it. If he speaks very hawkishly and there's no rate cut and it shocks the market, you could have a move to the opposite way, and then we'll be 100%, 180 degrees wrong, and we're okay with that. Our stops are tight.
Gold is trying to form a tradable low after a sharp correction, but the setup still depends on confirmation. The key level is around $4,350 to $4,360, where a clean breakout could turn pressure into momentum. Francishunt, a technical market analyst known as the market sniper and recognized for using pattern structures, volatility squeezes, and risk-managed trading levels, argues that the current gold and silver setup should be viewed through the balance between a possible Fed-driven breakout and the risk of one more shakeout. The main prediction is that gold could push toward the foothills of $4,700 if the Fed sounds dovish enough, and the neckline breaks with strength. The structure resembles an inverted head and shoulders pattern, supported by a volatility squeeze on shorter time frames and hammer-like rejection on larger charts. Still, the bullish case is not blind. A hawkish surprise, no rate cut signal, or renewed pressure from bond markets could quickly flip the setup. The better reading is bullish, but only with tight risk control. That means the trade is not about guessing the bottom, but about letting price confirm whether buyers can take control before policy headlines change the tone for metals again fast. Now, we present the clips from Francishunt's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
This is a head at a localized low for a gold chart that has been struggling recently. I'll go out on the bigger time frames just now. And there's your right shoulder for us. We call these armpits the interaction with the neckline. So that would be armpit 1. People can find out about our phraseology and our lexicon of terms. We only have and we only deal in horizontal necklines. It's the price point that matters. 4,360 is the magic number. You could probably argue that's 4,350 and you just run the levels normally. We pushed it a little bit. Why? Because we want the biggest projection, and the biggest projection will give us the target, which will bring you to the foothills of 4,700 if wash comes and does what we think. So that's an inverted head and shoulder. We'll see it. If he speaks very hawkishly and there's no rate cut and it shocks the market, you could have a move to the opposite way, and then we'll be 100%, 180 degrees wrong, and we're okay with that. Our stops are tight, and I'll show you why they're tight, because I'll just show you the smallest part of this trade, and that comes in here, in that right shoulder, and I'll wipe my face a little bit there. In that right shoulder is one of our favorite structures, which is a squeeze, a volatility squeeze, and for us, it's already triggered. So those following us on X, on themarketsniper.com, would have got this trade earlier this morning. Our community's been long precious metals, not just on this trade from this morning and last night, but actually for midweek last week, when we called oil short and the metals long. Suspecting something like this would come, and then, you know, the whole Trump priest thing, because this was not a good time to have rates messing with the NASDAQ with these listings. So you can see these are fatter candles. That's because of greater volume. We are on a 15-minute time frame. That is a triggering event. You got up to the key level, which is again that neckline, and you got a bit of resistance, and now you're building, and they're waiting for the announcement on what the news will likely be. So for those wondering what's all the talk is about, we are 18:16 now, so an hour and 44 minutes, and you will get the federal funds rate announcement. I imagine most people are expecting it to be no change, very low percentage for increase. And then you'll have statements and projections and press conferences that'll flow from that. And this will be, I think, Walsh's first of this version of presentation. The first one that is deemed a choice by Trump. I don't think he's a choice by Trump. I don't think Trump gets to choose these things, but he's more, the framing is that he's a Trump approved. In fact, there's some indirect family links in all of that as well, for those that are a bit conspiratorial. But he's more dovish, or expected to be, even though he's probably sold himself as in both ways, as potentially being a hawk. He won't be a hawk. Some of the things he's saying is quite intent on running lower interest rates than is truly required for what is a much higher inflation rate than is truly being reflected. So we'll see today how that worked, and those watching will see if we're winning or losing. If I go up to a weekly time frame, which whenever I'm looking for the grand macro feel, I look at candlesticks on bigger time frames. You can see typically when you get hammering, you're close to localized lows and upward moves. That was the only perfect hammer. That is a big rejection, similar to a hammer, the body tiny bit big for a hammer, but still significantly less than the lower wick, which is the rejection period. And you have, to some degree, hammering here on gold. You have it better on silver. I'll show you that if you're interested. So we've got the potential of a localized low here, but this was a bit of a sudden shooting star and pain. And it came quickly, and then dip buyers showed up. These were people who were in disbelief about the gold bull ending. Now, it didn't end, but at least had a medium-term downside move with setting up a fairly long time frame continuation pattern, which means in the end it goes up, but you've had a lot of steam and hype and margin being removed first. So you've got quite a strong rally immediately on gold, not as strong on silver. It sat quite a lot back. So we saw the gold-silver ratio going back. So we talk about three key sell-offs before you typically get the breakout or the return to bullish in the continuation pattern. There is one possibility. We have a split, a fork view. One is the crash that's already occurred here in that first initial slap in the face. It's not a full crash. It's a slap in the face because you came back to within $200, funnily enough, of the nearly 5-6 high. You went into the 5-400s here. So it was kind of the introduction of volatility that got taken back again, but you didn't make a new high. So it was a slap in the face. It could have been a warning. It could be counted as one of the three strikes of selling off. So the question then becomes, is that one of them? When I look on the weekly chart, you could make a case that you've had three and that this will then be bottoming out, and then you'll start going and then rebuilding and going higher. And then maybe a bit of resistance before you make new highs, maybe some form of winding up structure, and then you break higher, or maybe you come a bit lower and make a bigger winding up structure. That we're generally going to be heading higher with a few caveats to making new highs, a little bit of tenuousness. The alternative view goes something like this. This is all part of the rails of going up. That was just a bit of volatility, much in the way you got a bit of ahead of yourself. You got brought back on track and you continued up on track. You got a bit ahead of yourself. You got brought back on track and you continued up. So there was a little bit of people getting a bit excited along the way, but there was that steady move. That would make this the first clear, harsh rejection. And that makes for a very good foundational first hammer rejection. Then you've got this as a second impulse. So this would all be impulse one. You know, all of this from there down to there would be impulse one. The second impulse comes here as we are potentially reversing. If I think what happens, and we trade somewhat up to around 4.7, that could be impulse two. We want 3, remember. That could point that you actually could still correct one more time and have another localized low. Let's draw a hammer, for example. It doesn't have to be a new absolute low. I don't think you necessarily will get an absolute low on gold. If I'm guessing, I think that's probably the absolute low for this pullback period. I'm not talking about absolute of all time, of course. I'm just saying since our blow off high. So that could happen as an alternative, the pink route option, which then means you've made a third little loop, you've had a resistance, and then you break out from here. So there'll be one more up and over and around back down a little bit before you then start solid building on upward moves. And then again, you'll deal in whatever way you will with the localized highs. You might need a deep dip, or you might just need a small wind up, and you'll carry on up. So there's two views on that. And the one thing that gets tidied up on the pink view, that if we were to do that, is on the silver, and I'll show you the silver in a minute, it's a 3 impulse falling wedge. When I was drawing on the lower time frames gold, it's more of a broadening structure. Well, it can become the falling wedge on the weekly time frame if we were to get, that upward move that gets us to 4.7 and a little bit of a resistance and a little bit of a come down for a bit. You might notice that we have that, and we could also just as easily have something like that. I probably made that third impulse a tiny bit high. So if I join it again, maybe that. And that could also mean you also get a falling wedge structure coming out of this if we were to get a new high. Let me just fix that, sorry. So you could go up to 4.7 fairly promptly, and then you could come back down and have a little bit of an easing, and then we could break and go, and we're done with a continuation pattern. And that would give you 3 impulses where largely we don't count this too much. It's mainly wick. It's a period of extreme volatility. It was the warning, the slap in the face warnings, but that was the death top in the end, because that's when you crashed and you really failed substantially to make new highs. That would be impulse 1, 2, and 3. So that would be my framing. Two options. We'll go one of the two ways. One is a little earlier, one is one more up and over.
The bigger gold picture has 2 possible routes. One view is that the correction has already produced the 3 selling strikes needed for a continuation move, suggesting the market may soon resume its climb toward new highs. The other view allows one more up and over move, followed by another pullback before the final breakout. This makes patience important. Gold may have already made the main low of this pullback, but it does not need to move in a straight line. A rally toward $4,700 could still meet resistance, and another easing phase before the trend becomes clearer. The bias remains higher, yet the path may stay uneven. The cleaner strategy is to participate when levels trigger, then reduce exposure if momentum fades, because this kind of pattern can reward speed but punish anyone who refuses to adjust when signals weaken. Now, let's get back to the interview.
Silver is that you never made back as much on the after the first sell-off. So the slap in face was very real, and it had follow through. While gold trucked on for a little bit longer, it had a bit of disbelief before it then got spanked the second time harder. By that time, silver had already not rallied as far and didn't have such a big percentage sell-off. So again, the fork pattern, we've either got one impulse on silver here, but I will remind everybody that gold is still the God market, the decider market. You still will typically follow. And we're used to, when you get these kind of impulses that are very lengthy and broad, they took quite a lot of time to happen, that those are usually your second that happens, the bloated impulse. And when I talk, so they're usually second, which has me believe maybe this is an A, B, C, D down leg as well. And when I look at the gold, when we look at that shooting star and that immediate hammer, and then you still trade it quite strongly trending up, I think silver more likely follows gold. So this could just be one sell-off, and this could be our 2, and that's not a 2. That's just the fact that you had a bounce, a smackdown, and you came down in an ABC instead of just one straight line, which also would mean on the pink option, because I used pink with gold, that you would go one more up and over. Again, better hammer here from silver. You see, that's a hammer. It's kind of a green body, just. You could call it a doji. All of it is to the downside. Good rejection. If wash does what we think and you get beyond 75 part of the way, you could slow down again then. We got to remember we've got this peaky AI story. that's probably going to could see metals get sold off. So even when this eventually breaks, let's say that's your falling wedge, and you get it eventually, maybe it has this extra impulse, and this is all part of one. And again, I will show you just why I say that. The time between the top, that was the top, and that was the first low bottom there. That's very little time. That's why we call it a slap in the face. It's violent. And then you get that. The second impulse here, or the third, depending which you think, is by far the larger one. So I'm more inclined to combine these as one. I think we will trade long this move, but we will apply shoot and scoot rules. If it starts getting soft and coming off, we'll cut and run with any profits we have. Whilst normally if we were here and breaking and we were confident of our third impulse, once this breaks, you can still have a return move. We wouldn't care. We'd hold through the return move and just stack along the bottom even more and build further positions. And then we'd go. So explaining the pink route, if we caught out we actually, that is the first and this is the second and we already made the third, my slightly less convincing option, you would break straight out and this will be we're straight into it. Then we're going to be heading to new highs a lot quicker. So we'd probably get out here, and then when it return moves and it starts going again, we'd probably have to chase back in. So that's my less ideal, because I don't like out and in. But I think we got one more up and over in there. There's still the notion that the debt markets are going to be a comfy place, especially if Walsh starts talking, is dovish and has a dovish statement. The bond market is not long-term. People will be selling bonds if they think they've got a dove in the house. If it gives that away too easily. What everyone needs to realize, we told everybody in the 2020 of September, it's changed. The world has changed for the debt markets. Nobody believed us because we're minor, small, we have no gravitas on the big stage. Once Druckenmiller and Paul Tudor Jones came out and said, that's it, debt market is done, and everyone stopped talking 60-40. I have on my shelf How to Get Rich by Tony Robbins, who suddenly entered the financial space when he was interviewing Dalio, and the 60-40 portfolio is all in that. That book is outdated. It's done. And I was like shaking my head when I was reading about bonds and all of that. Well, that's happened now. And now, not just the mad guy on YouTube about it, now you've got respected financial billionaires saying debt market. So the notion that the debt markets aren't going to cause more chaos and start devaluing and causing rate moves to the upside and potentially AI sell-offs and everybody selling everything that isn't nailed down, because the one thing is institutions are over-leveraged. They're in everything, including bad assets. And when they are getting margin calls on bad assets, overvalued NVIDIA, overvalued SpaceX potentially, they're going to be selling their gold and silver as well. So first, when we get the panic, the demand-destroying event, which is inevitable, we'll probably have another sell-off in metals. Now, that could happen up top here as we start approaching new highs. It could be part of this down leg in the pink draw or the return move in the blue, but I think it's going to be a bigger thing, and that could pull us back down into range again. Just a couple of scenarios, thinking forward, how it might work, and how our brain works on a very simplistic level on how we model for various outcomes.
Silver looks constructive, but it is still likely to follow gold's lead. The stronger hammer-style rejection suggests buyers are defending the downside, and a move beyond $75 could open the next bullish phase. Even then, the market may slow, pull back, or form another falling wedge impulse before a cleaner advance develops. The wider risk comes from debt markets. The old 60-40 idea looks broken because bonds no longer offer the same comfort when deficits, inflation, and long-term rates are under pressure. If the Fed sounds too dovish, bond investors may sell, yields may rise, and over-leveraged institutions could be forced to liquidate whatever they can, including metals. That means gold and silver can be right in the long run, but still suffer during a panic that destroys demand. The strongest approach is to treat metals as a major upside opportunity while respecting the chance of another forced sell-off before the next durable breakout toward new highs. That is why chasing every green candle is less attractive than waiting for confirmed breaks, return moves, and stronger structure. The destination can be higher while the journey still includes sharp liquidations that remove leverage before serious buyers step back in again with conviction. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.